Welcome to the Deep Dive, the show where we take a stack of information and, well, really dig in to pull out the most important bits so you get the key knowledge fast.
And today, we're tackling something that sounds simple, but it really isn't.
Exactly. How long should someone serve on a corporate board? You might think, longer is better, more experience.
Or maybe shorter is better, keeps things fresh, more independence.
But it turns out it's way more complex. Get it wrong, and you could end up with what some researchers provocatively call a zombie board.
Huh, yeah, it's a catchy title for a really insightful piece of research. It challenges those simple assumptions. There's a definite balancing act involved.
We're diving into that balancing act today, guided by a fantastic 2018 paper. It's called, as you said, Zombie Board, Board Tenure and Firm Performance.
That's by HUANG and HILARY, published in the Journal of Accounting Research, a top-tier journal.
And our mission for this deep dive is pretty clear.
Yeah.
Unpack their research question. What were they actually trying to figure out?
Look at how they did it, their methodology, which is actually pretty clever.
Definitely.
Yeah.
And then get into their findings, which were quite surprising.
And finally, talk about what it all means, for corporate governance, for how companies actually work.
So, if you're interested in leadership, how decisions get made in big organizations, or you just want one of those aha moments about what makes companies tick,
then you're in the right place. This should be really interesting.
Okay, so let's set the stage. This whole issue of how long directors serve, it's been a debate for ages in the business world.
Oh, absolutely. You've got big players like Institutional Shareholder Services, ISS, the folks who advise big investors on how to vote.
Right.
They've pointed fingers, suggesting that maybe after 9 years or so, a director might be serving for an excessive amount of time.
And the worry there is entrenchment, getting too cozy.
Exactly. The concern is they might lose their independence, become less willing to challenge management if they've been there for, say, a decade or more.
Makes sense. You build relationships, maybe friendships. It gets harder to be the critical voice.
But then you have the counter-argument. People like Posen and Hammaker argued back in 2015, saying, hold on, what about directors who haven't been there long?
The rookies, basically.
Right. Are they really effective? They're still learning about the company, the industry, the specific challenges. Do they have enough deep, firm-specific knowledge to really add value or push back against a seasoned CEO?
So too short might mean ineffective, too long might mean complacent.
That's the tension. And what's fascinating is that despite this practical dilemma playing out constantly, academic research hadn't really zeroed in on the direct impact of tenure itself.
Most studies looked at other things, like how many independent directors there are, or just the size of the board.
Precisely. The actual length of service wasn't the main focus.
And that's where HUANG and HILARY come in. They decided to tackle that core trade-off head-on.
Yeah, they wanted to understand how board tenure balances that need for independence against the need for knowledge accumulation.
And how did they measure that?
They focused on a specific metric, the average number of years served by all the outside directors on the board. Not inside directors like the CEO, but the independent ones.
Okay, so that average figure becomes the key number.
Right. So throughout our chat today, when we say board tenure, that's what we mean. The average time those outside directors have been serving, it captures both that potential for knowledge and the risk of, getting stuck.
Okay, let's unpack this.
Yeah.
So it's like walking a tightrope, isn't it? You need enough time to learn the ropes and actually know what you're talking about, but not so much time that you just blend into the furniture and stop questioning things.
Precisely. Which raises the big question. Is there an optimal point? Does that perfect balance actually exist?
And that leads us right into their main discovery, doesn't it?
It does. And it's not what you might intuitively expect. They found that the relationship between board tenure and company performance isn't just a straight line like more is always better or worse.
It's different.
It's what researchers call an inverted U-shaped relation.
An inverted U. Okay, picture that.
Yeah.
Like a hill. Performance goes up as tenure increases.
Up to a certain point.
Hits a peak.
And then starts to decline as average tenure keeps getting longer.
Wow. So there is a peak performance point. Did they figure out where that peak is?
They did. Their analysis suggested that firm value tends to reach its maximum when the average tenure of outside directors is approximately 10 years.
10 years. That's quite specific.
It is, and they really tried to nail down the economic significance. What does this mean in dollar terms?
Yeah, does it actually matter to the bottom line?
Apparently, yes. For example, moving from an average tenure of 5 years up to 7 years. So moving up the left side of that inverted U was associated with about a 2.7% increase in firm value relative to its standard deviation.
Okay, that's not trivial.
Not at all. And on the other side, if you had a board with, say, 13 years average tenure, and it dropped down to 11 years moving back towards the peak from the right side.
You'd expect performance to improve.
Exactly. They found that was associated with about a 1.3% increase in firm value. And they saw similar inverted U patterns for things like return on assets or ROA.
So higher ROA up to that 10-year mark, then it starts to dip.
That's the pattern they found. Significant increases in ROA as tenure approached the optimum and then decreases as it went past it.
And this wasn't just about overall value or profitability, right? Did it affect specific decisions boards make?
Yes, that's another key part. They looked at major corporate decisions and found the same pattern, things like M&A acquisitions.
So boards around that 10-year average tenure mark made better acquisition decisions.
The performance of those acquisitions tended to be better, yes. Improved up to the peak, then declined. Same for the quality of financial reporting and disclosure.
Interesting. Even CEO pay.
Even CEO compensation practices the level of pay, how sensitive it was to performance that also showed this inverted U-shape linked to average board tenure.
So straying too far from that, maybe 8 to 11-year optimal zone, really seems to hurt performance across the board.
The numbers suggest so. They found that average tenure below 8 years was linked to about a 4.3% lower firm value compared to that optimal range.
Okay.
But get this, average tenure above 11 years. That was associated with a whopping 9.7% lower firm value.
Wow, nearly 10% difference compared to the sweet spot. That's huge.
It's a very significant finding, but, whenever you see correlations like this, the big question is always causality.
Right, the chicken and the egg problem. Is it that long tenure causes bad performance?
Or do poorly performing companies just struggle to attract new directors, so the existing ones end up staying longer? Or maybe successful firms just know how to manage tenure perfectly. This issue is called endogeneity in research speak.
It's hard to untangle cause and effect just by looking at correlations. So how did HUANG and HILARY tackle that?
This is where their study gets really clever, I think. They used a natural experiment, something unexpected that changes board tenure but isn't caused by the firm's performance itself.
Okay, like what?
They used the sudden death of an outside director.
Whoa. Okay, that's definitely unexpected and, well, external.
Exactly. It's what researchers call an exogenous shock. It's an event from outside the system that randomly changes the variable you're interested in here, the average board tenure, without being influenced by the company's own situation.
So a tragic event provides a sort of random jolt to the board's average tenure. How did that help establish causality?
They looked at how the stock market reacted right around the announcement of a director's death. And they found something pretty compelling.
What was it?
If the director's death happened to push the board's average tenure away from that optimal 10-year zone.
Making it either too short or too long on average.
Right. The market reacted negatively. On average, there was a negative 1.4% stock return around the announcement.
Okay, so the market saw that shift away from the optimal as bad news.
But conversely, if the director's death, just by chance, happened to move the average tenure closer to that 10-year sweet spot.
The market liked it.
Yes. They found a positive 1.0% average announcement return.
That's fascinating. Because the death itself is random, the market reaction seems directly linked to the change in tenure relative to that optimal point.
That's the argument. It provides much stronger evidence that the relationship is causal, that board tenure itself actually impacts firm value, not just the other way around.
If we connect this to the bigger picture, it's like using a tragic, random event to peek under the hood and see how the machine really works. It suggests tenure isn't just a side effect, it's actually a lever.
A very powerful lever, it seems. Which brings us back to the why. Why this inverted U-shape? What's happening?
Right, what's driving performance up initially and then pulling it down later?
The authors argue it's driven by that core trade-off we mentioned earlier playing out over time. They identify two key mechanisms, learning and entrenchment.
Okay, so learning first. That dominates in the early years.
That's the idea. For younger boards, those on the upward slope of the U, the benefits of directors gaining experience, learning about the company, the industry, accumulating that crucial firm-specific knowledge, those benefits outweigh the potential downsides.
They're getting better at their jobs, basically.
Yeah.
Better at monitoring, better at advising management, because they actually understand the nuances.
Exactly. You need time to build that expertise. It's like any complex role.
But then, after that peak around 10 years, something else takes over.
That's when they argue the costs of entrenchment start to
They're
dominate.
getting too comfortable again.
Right. Directors might become too familiar, maybe too aligned with management's perspective. Their independence could erode. They might become less likely to ask tough questions or challenge the status quo.
And that leads to poorer oversight, maybe rubber stamping decisions that aren't actually good for the company.
That's the risk. It could lead to value-destroying decisions or just weaker monitoring overall. And they note this isn't a totally new idea. Similar concerns exist in research on how long audit firms should work with the same client. Too long, and maybe the auditors lose some skepticism.
So it's this constant battle, gaining knowledge versus losing independence. And the balance shifts over time.
Precisely. And it's not just a simple story. They found other factors can influence this balance, too.
Like what? What makes the downsides of long or short tenure worse?
Well, one big factor is CEO power. They found the negative effects of long board tenure, that entrenchment problem were significantly worse when the CEO was already very powerful or entrenched themselves.
So if the CEO has been there forever, or they're also the founder, or they chair the board.
Then a long-tenured board might find it even harder to challenge them. The entrenchment gets amplified. It's like a double dose of coziness, potentially leading to weaker governance.
That makes a lot of sense. What about the other end? When is short tenure particularly bad?
That seemed to be more of an issue when the company's information environment was complex or murky.
Meaning, hard to figure out what's going on.
Yeah, think about companies with low coverage from financial analysts, or where analysts really disagree about the company's prospects, or where their
Right.
forecasts are often wrong. It suggests information is hard to come by or interpret.
And in that kind of situation,
A board with short, average tenure, lacking that deep accumulated knowledge, might really struggle. The learning curve is steeper and more critical when information isn't clear and easily available, so the cost of inexperience is higher.
so the context really matters. It's not just the average tenure, but also who the CEO is and how complex the business environment is.
Exactly. They also briefly looked at tenure diversity, not just the average, but the spread of tenures on the board.
Did having a mix of long-serving and newer directors help?
It seemed to. They found that when tenure dispersion was low, meaning pretty much everyone had been there a similar long amount of time, the negative effects of that long average tenure were even worse.
Suggesting that having some fresher perspectives mixed in might help mitigate that entrenchment risk.
That seems plausible, yeah. It points towards the value of having a mix of experiences and viewpoints, not just in terms of background, but also in terms of time served on that specific board.
So, stepping back, what are the big contributions here? How does this change how we think about boards?
Well, first, it really shifts the focus. It moves beyond just looking at who is on the board, their independence on paper, their skills, to emphasize the critical importance of how long they've been there, the tenure dynamic itself.
It adds a time dimension that was maybe overlooked.
Definitely. And second, it highlights that a director's impact isn't just about their individual contribution. Their arrival or departure changes the board's average tenure, and that structural change has consequences.
Like we saw with the sudden death analysis. Adding or losing one person can shift the whole board relative to that optimal point, impacting firm value.
Precisely. It shows the board functions as a system. And third, it really informs that ongoing debate about mandatory term limits for directors.
Because it suggests a simple cap might not be the best idea.
Right. If there really is an optimal range, and that range might shift depending on the company's context, then a blunt one-size-fits-all limit, say 9 years or 12 years, might force some companies away from their optimal tenure, either kicking effective directors out too soon or not addressing boards that are already past their peak.
So what does this all mean for someone trying to build or understand an effective board? It sounds much more complicated than just ticking boxes.
It absolutely is. It tells us you can't just focus on recruiting star directors. You also have to think about managing the overall tenure structure of the board over time. And you need to consider the context, the CEO's position, the information environment.
It's not a static checklist at all.
No, it paints a picture of board effectiveness as this dynamic ecosystem. It really pushes back against relying solely on fixed rules or generic best practices and encourages more critical, context-specific thinking.
So recapping this deep dive into the zombie board paper, the core takeaway is this really nuanced relationship between how long directors serve and how well the company does.
That inverted U-shape. Performance improves as directors gain knowledge, but then declines as entrenchment potentially sets in.
With a kind of sweet spot around that 10-year average tenure mark.
But remembering that factors like how powerful the CEO is or how complex the business is can definitely influence where that ideal point lies for any specific company.
It's a dynamic puzzle. Which leads to a final thought, maybe something for you, the listener, to chew on.
Given all this complexity, the U-shape, the moderating factors, even the measurable impact of something as random as a director's sudden death.
Yeah, it makes you wonder, how much real control do companies actually have over keeping their boards perfectly optimized? Is it even possible?
Or are they, as some researchers suggest, always just sort of dynamically learning and adjusting, constantly moving towards an optimal level, rather than ever truly reaching and maintaining it perfectly? Are they always playing catch-up with these complex forces?
What stands out to you from this deep dive? Is perfect board governance an achievable goal or more of an ongoing journey?
It certainly suggests it's more of a journey, constantly influenced by factors both internal and external, planned and unplanned. The idea of a permanently perfect board seems quite challenging in light of this research.
Definitely food for thought. Thanks for joining us on the deep dive.
We'll be back soon to unpack another set of fascinating sources.